And that addiction is being preyed upon by game companies to extract a lot of money out of a surprisingly small group of people. One of my most recent videos was on the predatory monetization of video games, where I spoke about how game developers were using dishonest tactics to get hundreds or sometimes even thousands of dollars out of their players. I think it's only right to follow up a video about video games being turned into major financial commitments with another video about major financial commitments being turned into video games. The growth and popularity of zero-commission brokerages has allowed many first-time investors to enter the market without having to pay costly brokerage fees that would have made their investments pointless in the first place. Before platforms like Robinhood, the industry standard for stockbrokers was to charge a fixed price for every trade made on both the buy and the sell side, normally 1 to 2% for orders over $5,000. The business model usually included minimum brokerage fees that could be as high as $50 per trade, so someone who only wanted to invest $100 a month would instantly be down 50% on their position the instant they entered the market. They would also lose another 50% of their initial investment when they exited the market because brokerage fees were charged on both the buy and the sell side. Stockbrokers got a bad reputation for encouraging their clients to trade as much as possible, often based off dubious stock picks, all in order to get as many trades through their desk as possible, because more trades meant more fees and more commissions for the individual brokers on the other end of the telephone. This is what was depicted in one of the early scenes of The Wolf of Wall Street, where Jordan Belfort was a rookie on the trading floor. His job was to try and connect licensed financial brokers like Matthew McConaughey with high net worth investors so that the brokers could talk them into making a trade and collecting their fee along the way. When Belfort went to his job interview at Investor Center and talked about making 1% commission at LF Rothschild, that's what he was referring to.
What do you get on a blue chip stock?
I make 1%. I did make 1%.
Pink sheets, it's 50.
The fees that stockbrokers charged were high, but at the time, they were not entirely unreasonable in the days before automated trading settlements. Back then, the client's buy or sell instructions had to be given to individual traders on the actual stock trading floors of exchanges around the country, so it made sense that clients covered these costs with some margin so that the brokers could still turn a profit by providing this service.
It's 50%? 50% commission?
Yep.
For what?
It's our markup for our services.
But then came along automated settlement, which meant that now buy and sell orders don't interact with humans at all apart from the people on either end of the trade. Cutting out all the people in the process reduced the expense of facilitating stock trades, which allowed brokers like Robinhood to come along and offer trades completely for free. For most traders, commission-free brokerages are a much better alternative to the better traditional brokerages that for some reason still think it's fair to charge normal retail traders fees of up to 2%. But they are also not charities. The major commission fee trading platforms are multi-billion-dollar companies, which means they have found other sneakier ways to extract money from their clients. There are several hidden costs to using these platforms, which means that just like the Jordan Belfort-style stockbrokers of yesteryear, they're making money off novice investors every time they trade. And the more trades they get people to do, the more money they make. The only thing that has really changed between then and now is how they make their money and the strategies they are implementing to get people to trade as much as possible. And that's by turning the whole process of investing into a giant game, where instead of making diligent and consistent contributions to a well thought out portfolio, investors will instead play for high scores and compete with confetti animations while using financial instruments that they should not reasonably have access to.
Round 1. Fight!
So it's time to learn how money works to find out how the gamification of investing is costing average people billions of dollars every year and why people keep falling for these tricks. This week's lesson was made possible by Incogni. Whether you know it or not, there's a good chance that your personal information is being sold online without you even knowing about it. In fact, in 2021, it's estimated that there were 68% more privacy breaches in the prior year, which is frightening. The good news is that it's your right to protect your privacy by requesting data brokers delete information they have about you. But the problem is that takes years to do manually. With your personal data in the hands of data brokers, you run the risk of their databases being compromised along with your personal information. Fortunately, Incogni is here to help. Incogni reaches out to data brokers on your behalf, requests personal data removal, and deals with any objections from their side. And it's real easy to do. You create an account and tell them whose personal data you'll be removing, grant them the right to work for you, and they'll reach out to data brokers and request the personal data removal for you. It's that easy. Let Incogni handle the work for you, and give yourself the comfort that your private data won't be floating around the internet. And the best part is that Incogni is available risk-free for 30 days, meaning anyone can try it out themselves and get a full refund if they aren't happy with the service. Sign up for Incogni at incogni.com/money. The first 100 people to use the code MONEY with this link will get 20% off Incogni. You have probably heard the phrase, if something is free, you are the product, and that's certainly true of most commission-free brokerages. One of the main ways that these companies make money is by routing order flow through major institution partners like market makers. How this works is that when you place a trade, the broker would usually go to the exchange the stock you are trading is listed on. For example, if you wanted to buy a share of Disney, the broker would go to the New York Stock Exchange and try and find someone selling a share of Disney. The price that you can go out and instantly buy a share of Disney at, the offer price, is always going to be higher than the price you can sell a share of Disney at, which is the bid price. What some brokers have started doing is instead of going all the way to the exchange, they go to their institutional partners to fill the order at the price matching the offer price if their client is buying or the bid price if the broker customer is selling. These partners will create their own little market with these buys and sells. That little market is something called a dark pool. It's called a dark pool because it's a market that manages buy and sells of publicly listed assets, but nobody outside the firm running the dark pool can see what's going on inside. Dark pools might conjure up some images of evil financiers secretly controlling the world's finances in secretive shady markets, and there are definitely people that would have you believe this is the case. But all the dark pool lets these companies do is make the difference between the bid and offer price every time they facilitate a trade. For a major company like Disney, the spreads between the bid and offer or ask price will be very low, sometimes just a fraction of a penny, so there isn't much money to be made there. But companies with lower trading volumes will have much bigger spreads, advanced financial instruments like options will have even bigger spreads, and options with low trading volumes like Wall Street Bet's favorite out-of-the-money call options will have the highest spreads of all, sometimes as much as 20% of the price of the option. Without these market makers, some of the more degenerate trades that people utilizing platforms like Robinhood want to make might never get filled. But for the price that people pay for that liquidity, these institutions almost act like a casino. They facilitate games of chance where they have a slight edge with every trade. Because being able to accept trades with the margin already in their favor is so lucrative, these market makers will pay the brokers a handsome commission to be the first in line to receive these trades, a practice known as payment for order flow. There is nothing necessarily wrong with this practice. The broker still has a fiduciary duty to find the most competitive price in the market to execute their client's trade at. So if they could find a better deal at the public exchange, they are obligated to do it. But that doesn't stop them asking a market maker if they want to match that price first. For an investor that is only making 1 or 2 trades every month, this hidden cost will be almost imperceptible. It can also increase the speed in which trades are processed. There have been some controversies like Robinhood's halting of GameStop purchases during the famous short squeeze of 2020, a move that the company claimed was to protect new investors during the period of market exuberance.
We always remain focused on making sure the system is reliable, that we're investing in stability, making sure we're up for customers when they need us the most.
Robinhood made some of their revenue from financial firms that were short GameStop, making many believe that they halted trading to keep their biggest financial contributors happy.
Now, for everyone involved in this was a gamble. This was not investment.
Whether you think this revenue model is designed to exploit investors by giving market power to a few powerful hedge funds, or if you think it's just a clever way to subsidize free trades for investors, the indisputable truth is that the more trades people make and the more exotic the financial instrument being traded, the more money the brokerages will make. So they have a business interest in getting people to make as many trades as possible. The average rate of return of the S&P 500 over the past 100 years has been approximately 10%. By all means, a great return that can compound to grow sizable fortune if combined with a diligent savings plan. A 10% annual return will double the size of a portfolio every 7 years before even considering any extra contributions. But to a lot of people, that's not good enough, which is why they turn to more volatile tools like options, which have the potential to double the size of a portfolio in a single day. But do you know what the average annual rate of return for a diversified portfolio of options is? It's 0%, or less than 0% after the market spread is accounted for. Options are not an investing tool, they are a risk management tool, but if people knew that, they would be much less likely to play with them. Instead, brokers have started promoting their options trading utilities as a selling point, and have made getting into extremely risky trades very simple. Everything down to the design of many commission-free brokerages is designed to make it as unintimidating as possible so people feel comfortable playing the markets like they would playing a video game. I am all for letting people do what they want to do with their own money, provided that the risks are properly disclosed, which in many cases they aren't, so I guess I will do it for them. These are 4 ways in which the gamification of investing is costing average investors money. The first way is by getting them to invest more often than they would if the process properly reflected the seriousness of the financial actions their clients were making. Some people should simply not be investing in the market at all. Most financial commentators that talk about the hidden costs of commission-free brokerages will round out their argument with a point about how it's still good that these platforms are giving smaller investors access to the market, but this is really only half true. If someone is absolutely committed to putting $100 into the market every month, a commission-free brokerage is definitely the best way for them to do that, so they aren't losing a good chunk of their investment to brokers' fees. However, I'm going to get a little bit controversial here, and say that someone who can only spare $100 a month to invest probably shouldn't be investing in the stock market. That money would better be spent contributing to an emergency fund, learning a new skill that could make them additional income, or simply paying down debt. A 2020 article found that 42% of Robinhood and 41% of TD Ameritrade users had FICO scores below 650, which suggests very bad creditworthiness caused by a history of not paying off financial obligations. If someone is paying 20% interest on a credit card that they are trying to get rid of, the contributions they make to their portfolio are going to end up costing them even more money because they are not going to be able to make 20% annual returns consistently unless they are the next Warren Buffett. But then again, Warren Buffett didn't start off with credit card debt. I know it sounds like I'm gatekeeping by saying that it's only for people who already have lots of money, but I promise that's absolutely not the case. It's just important for people to realize that investing isn't automatically good, and people need to assess their personal financial situation before making investments to work out not only if it will make them money, but also if there are better, safer ways for them to make more money. Gamified platforms with fancy graphics, leaderboards, giveaways, and emphasis on trendy stocks make it easy and emotionally rewarding to drop money into an account and just start playing with it. Compare this to an old-school fee-based broker like Schwab. You know, the one that the boomers with real money use, and the percentage of accounts with FICO scores below 650 falls to just 33%. The intimidating and serious nature of the platform in conjunction with paying upfront fees serves to stop people that shouldn't be making stock investments from those that should be making stock investments. The second way that the gamification of investing hurts investors is that it encourages them to take on riskier positions in order to try to maximize their score. Whether that be talking about how their returns beat Ray Dalio or their losses topped Bill Hwang. I've been picking on the brokers a lot so far because they are definitely silently encouraging this kind of behavior. But the rise of online groups like Wall Street Bets and the endless list of TikTok stock pickers deserves their share of blame as well. Good investing should be boring, and it should be just like the plumbing in your house, working quietly in the background to get what it needs to get done. It's important to have a basic idea of how it all works, or at least know a good professional that can set things up for you. If you watch hours of content about how to improve the plumbing in your home and then try all the new tricks out yourself, you are probably going to make things worse. I know that sounds dumb, but for some reason people do exactly the same thing with their finances. The third way that the gamification of investing hurts investors is that it reduces the amount of time that they stay in their positions. We all know that a diversified portfolio is important for building long-term wealth, but what's just as important as the diversity of what is being held within the portfolio is the diversity of the time horizon it's held over. Investing in good times and bad times makes sure that you are never getting in at the top or the bottom of the market. The average return of the market is roughly 10% per year, but a study by Dalbar Inc., a company that studies investor behavior, found that the average investor was only generating returns of 4.25%. The leading cause of this shortfall was that investors would move in and out of positions frequently instead of adopting the long-term buy and hold strategy that would give them market returns. A similar study by QuiverQuant, a market analysis company using Robinhood's public API feeds, found that the average Robinhood user was even worse off, trailing market returns by 6.2%. If you make something a game, people are going to want to play it. But chasing meme stocks and high return option plays is going to hurt people over the long term. Even if we take the investor only making $100 worth of contributions every month, 6.2% compounded annually with those contributions over 40 years, that's $196,000 worth of lost wealth they are missing out on. Part of the reason that people so easily fall into the trap of making all or nothing plays with their investments is that they realize that everything has become unaffordable and that even the most diligent investment plan will not let them achieve their financial goals. The only hope becomes making risky plays that they know won't work out, if only for that 1 in a million chance that they become the next GameStop or Dogecoin millionaire. If that was a bit depressing for you, then my video on why you are never going to retire should cheer you right back up again. A special thanks again to Incogni for making it possible for everybody to keep on learning how money works.
Wendy! Bitch, don't you want to start making some real f***ing money? Leave me alone. Well, you were made for the playground, bitch.